Earnings season full swing. 85% of S&P 500 companies reporting Q1 earnings so far. Earnings are down 1.3% with sales growth rising 3.8% according to data from Evercore ISI. And we're watching one company in particular today, Lyft investors. They are slamming on the brakes this morning with shares plummeting 15% ahead of the opening bell. The ride-sharing company posted a beat for the first quarter but fell short on revenue expectations, forecasting between $1 billion to $1.02 billion, where analysts were expecting $1.08 billion.
Well, investors are looking at a potential pause in the Fed's rate hike following the continued pressures in the banking industry, but economic data, like today's jobs report, still remains a key player in the Fed's policy decisions. Here with how investors can position in anticipation of the Fed's next moves is Jordan Jackson, JP Morgan Asset Management Global Market Strategist. So now we may be in a pause environment, Jordan, right? Although I guess there's a little bit of question after today. So what does that mean for investors sort of operating with a pause now instead of this rising rate environment?
Sure. So we've looked at some of the numbers in terms of historically how markets have performed after that last Fed rate hike. And we've looked over the last 5 to 6 rate hiking cycles. And it's sort of in line with what one would expect in terms of the Fed pausing in an environment in which the economy is beginning to come under pressure. You tend to see long duration outperform short duration. You tend to see high quality outperform low quality. And so you tend to see defensives outperform cyclicals. And so that's very much how we continue to position portfolios today. Certainly today's report raises the risk that the Fed either could keep going or actually at least not cut rates, right, in the back half of this year, pushing against market expectations. I think investors have to be very careful here, though. The labor market is always the last shoe to drop when we think about broader economic activity and whether the economy is coming under pressure. You did see significant downward revisions in job growth over the last 2 months. Yes, I know the wage inflation number came in certainly hotter than anticipated, but the banking stress is going to feed its way into the labor market, and I think in a couple of months here, maybe in a couple of quarters. Right. The majority of the labor force is employed by companies that have 500 or fewer employees. And most of those companies bank at regional banks. And a lot of these regional banks are coming under significant pressure. And so these businesses are facing higher cost of credit, a more restrictive availability of credit. I think that's going to lead into some broader weakness in the labor market. And so another rate hike, I'm not welcoming that from the Fed.
So if the employment situation data is the last shoe to drop, Jordan, is there other data? Are there other places that investors can look to get a better pulse of where we stand, and especially with the calls that we've seen for a recession in Q3 of 2023 to best position themselves to be even defensive, as you were mentioning?
There's certain labor market indicators that are somewhat forward-looking. The quits rate in the JOLTS report tends to be a decent indicator. Elsewhere, when you look at things like new orders relative to inventories and the PMI data, that would suggest that things are beginning to roll over. The Conference Board's leading economic indicator has also continued to signal a contraction in the quarters ahead. And I think the Fed, looks at all this for sure, but there's an issue that I have of them being laser focused on one number, and that's the inflation number. And I think the inflation is going to continue to gradually move lower. Yes, we did see a modest pop in the wage figure this morning, but I think that we're still on a downward trend, and particularly as I highlighted, the banking stresses certainly should lead to some broader weakness in the labor markets, again, as that availability and cost of credit become more restrictive.
I do want to ask you about those banking stresses a little further, Jordan, because obviously we have seen a plunge in the regional banks this week and maybe dashing hopes of folks who said that the worst of this was over. Do we have to reassess that? And I keep trying to figure out, as we see investors, yes, they're buying this morning, but we've seen them selling this week, if there are really fundamental issues at these banks or if it's hysteria or, I'm just trying to figure out what is really going on here.
I think there is some fundamental issues, right? Many of these banks are subject to interest rates, and we've seen the fastest rate hiking cycle since the 1980 tightening coming from the Fed. And so they've got it. There's this conundrum where they're forced to either pay more in deposits or see deposits fly out. And then on their asset side, a lot of their bond and securities holdings are losing value. So that creates a big challenge. And I think what we've gone from is, maybe acute stress to a slow burn. And so I think a lot of investors are looking across the banking spectrum. They're looking at what are potential losses on unrealized securities holdings. They're looking at deposit flows. And they're trying to assess just how much painful this could really be. But again, the stresses are very much on other small and regional banks. We're actually seeing certain larger banks are actually seeing deposits increase and kind of capturing some of those outflows. So again, I think this is more of a slow burn. Investors will continue to remain focused on the small and regional banking sector, but I think there may be a little bit more pain to come.
Jordan, as we've continued to watch the CME FedWatch tool kind of bounce around here today, at least in the figure for where a hike has re-entered the conversation as well, or re-entered the chat, there's kind of this inclination to think about, well, you've still got the outsized probability that the Fed will pause. If the Fed does pause, are we likely to see kind of just sideways trading for the extent of time that they decide to just monitor where the economy has digested some of the rate policy that they've enacted and QT that they've put forward at this point?
I think so. I think it's going to be a very volatile market. I think it's going to be a very choppy market. Investors are going to be focused maybe a little bit more on what our earnings going to do, how the broader economy is going to perform, inflation data as well. So to some extent, it removes a bit of volatility if the Fed is willing to stay on pause. If they become active again, that might bring renewed volatility both to the bond market as well as the equity market as they try to make sense of what the trajectory is likely going to look like. And so I think, markets are going to be pretty choppy. Again, as I've highlighted at the outset of the talk here, I think you want to stay defensive, right? The economy is coming under some clear pressure. Consumers are coming under pressure as well. I know the consumption numbers in the first quarter were quite strong, but a lot of that was driven by, most of that pop was driven by generous bump in Social Security payments in the month of January and a relatively milder winter. But we're starting to see a modest uptick in delinquencies across credit cards and auto loans. Again, all signs that the consumer and the broader economy are coming under a bit of pressure, and the banking stresses only add to that pressure. And so, again, all this supports a more defensive, high quality, maybe stepping back into a little bit of duration within portfolios. And hopefully the Fed has the resolve to stay a little bit more cautious and calm here as the broader economy comes under some pressure.
We shall see, right? Jordan, it's great to see you. Jordan Jackson, JP Morgan Asset Management Global Market Strategist. Thank you.